Hello, my name is Michael Lewellen. I'm the Director of Financial Planning at OJM Group, and today we're going to be discussing the importance of having a multidisciplinary financial plan. Before we jump in, it's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstance. Please contact a professional before attempting to execute any of these strategies. Also, please review the disclaimers. We've written over 10 books for physicians and business owners. At the end of this webinar, you're going to get the opportunity to receive a free book. We would love to get a copy of it to you. We have a Kindle and iPad version as well as hard copy versions that we can get you as well too. The agenda today: what is coordinated wealth planning? We'll define that, and then we will define each area of coordinated wealth planning and the pitfalls of each. We'll also cover avoiding the pitfalls of uncoordinated planning, evaluate do you have the right team, who do you need to be on your team, and then who should be the quarterback of that team. And obviously we'll define what the quarterback is there at the end. Coordinated wealth planning. So from our perspective, it includes all of the following. It's important to understand that some of these areas may not be applicable to you. So you can, for example, if you're an employee benefit planning, you don't have a whole lot of control there, same as corporate structure. But the ones that are applicable would fall into your coordinated wealth plan. So asset protection, estate planning, investment management, tax reduction, insurance, benefit planning, corporate structure, and then financial planning. So let's look at each one individually. Asset protection. For a lot of our clients, this planning and part of our process when clients work with us is David Mandel, one of our partners, does a complete review of their situation from an asset protection perspective. So some of the pitfalls that we encourage clients to try to avoid: using complicated legal tools that have limited asset protection. So you can have a big fancy plan, and it very well could be good and could have multiple purposes, but if your primary purpose is asset protection, you may not be getting any additional protection. It may have more of an estate planning benefit than it actually does from an asset protection perspective. International trust, that's something obviously that was very popular 10, 15 years ago. Not that it doesn't have a place at all, but the level of protection isn't quite the same. And when clients are educated on what the upside would be of doing that, it definitely the cost just doesn't make a lot of sense for clients. So really understanding that's kind of a hot button topic that people go to a lot, but is there really a benefit to doing it? So some of the remedies: use what the government gives us. So you have federal and state exemptions. So a good example of that would be your 401ks, any qualified plans. IRAs would be good examples of that. So again, whatever is being given to you. In some states, cash value life insurance is fully protected. Some states, your home equity is 100% protected. So those are all things that you want to take advantage of. So that really falls into line with the best asset protection is not asset protection. So if you've heard David Mandel speak or read any of our books, you've probably heard that line before, and that's just conceptually using the idea of taking advantage of what's available to you. And generally, those are the best tools that are going to give you the highest level of protection. Estate planning. Some of the pitfalls: designing an expensive estate plan too early. So what we see oftentimes with clients, they may come to us and say, oh, we set up all of these trusts and did all of these things. That doesn't make it a bad thing. It just means, is it going to be appropriate for what your goals are 10, 20, 30, 50 years from now? Or is it just set up conceptually that it'll work, and then, down the road you may end up having to make changes to it? We're a big believer in, one of the remedies you can see down there is growing into your plan. So making sure you have the estate planning done that's appropriate for you today. Doesn't mean that something won't be appropriate for you in the future, but grow into your estate plan. Don't feel like you have to do everything and add complexity to your situation when it's not necessarily needed right now. Just do the planning that's needed at your time. Using legal tools that are less protected or makes access to funds difficult or impossible. A lot of times, estate planning, you can be using the use of irrevocable trust, something along those lines. Clients say to us they want to get things out of their estate. Can I put it into this irrevocable trust? Some of the issues with that, you lose access to your money, and obviously that doesn't make a lot of sense, especially if you're on the early end of your life expectancy. But I think the big takeaway is just be willing to grow into your estate plan. Don't feel like that you have to have a complex plan right now today. Define what you need right now. Work with a good attorney that's able to help you with that, and then be willing to grow into your estate plan. Investment management. Some of the pitfalls, having all of your investments go towards vehicles that you're not going to be able to access until retirement or without penalty. So you're illiquid. Good examples of those would be the 401k, defined benefit plan, IRAs. So our message isn't not to use those tools, but it's to take into consideration the need for liquidity. The best example of that would be someone that comes to us and they may be fully funding their 401k, but they would also like to be saving more into pre-tax vehicles. So that's not a bad thing, but it's just understanding your situation. So the use of a defined benefit plan, for example, where you're able to get $100,000, $200,000 away. Just make sure that that fits in to your overall plan, that you're not making yourself too illiquid. Ignoring taxes, so just chasing tax deductions there. Obviously, we all like tax deduction. We want more tax deductions, but take into account the cost of some of that as well too. And that's also true with ignoring taxes from an investment perspective. Make sure you're doing proper tax harvesting and that your investment advisor are taking those into consideration. Not investing according to your risk tolerance. That's something that's really important. One, you want to make sure that you understand what your risk tolerance is. So that's a really important thing. A lot of clients come to us and they don't truly have a good understanding. And then make sure that your allocation of your portfolio matches up with that. You don't want to be taking on more risk than you really want to, and then there's a market correction or something happens. Have a balanced approach. So obviously have the proper asset allocation. That's a remedy that is pretty straightforward there. You also want to be allocated in different buckets that you're using. As we talked about before, determine your risk tolerance. And a really good way to do all of those in one is to develop an investment policy statement. So if you don't have an investment policy statement with your current advisor, it may be worth reevaluating your current advisor, make sure that they're really in line with what you're doing, but you might want to take the steps to see if you can find an advisor that does that. This is a really good tool to really hold each other accountable. This is what your expected rate of return is. This is how you're going to be allocated. This is your risk tolerance, all those types of things. So it's a really good piece to use for an investment advisor as well as a client as well too. Tax reduction. So some of the pitfalls, not knowing what's available to you. Earlier before we talked about illiquidity and using different types of pre-tax plans that allow you to defer additional dollars. Again, those have their place, and in this situation, a lot of times clients that do have the ability to be putting more away and still have liquid assets aren't getting the proper advice and aren't aware of all the tools that are available to them. So a defined benefit plan, a cash balance plan, they may be familiar with those, but maybe they were told that they didn't work, maybe they don't have a good understanding, maybe they didn't go to someone who really knows how to design them the right way. So really evaluating, really understanding what is available to you and makes sense for you. As we said before, you don't want to do something just to save taxes. So when you do some of these additional plans where you're able to defer additional dollars, well, there can be expenses with that. If you have other employees, obviously contributions have to be made on their behalf. So you need to evaluate it not just from what can you put away additional, but what does it look like. And only considering current tax savings. I think that's a really important one to consider. People don't really think about that, but what we talk to clients a lot about is tax diversification. So do you want to pay less taxes today, or do you want to pay less taxes overall? So that means allocating dollars to vehicles that are going to have favorable tax treatment in the future. The best example of that would be a Roth IRA or a Roth 401k if you have that available to you. Obviously, there's limitations on those. One that we use for our clients, if structured properly, could potentially be cash value life insurance. And also, it's not a real favorable time for bonds, but municipal bonds have very favorable tax treatment throughout as you're taking dollar out, so not necessarily a benefit on the front end of it. You know, a lot of clients just chase that tax deduction. We encourage our clients to have a more holistic view of taxes. So remedy, again, see what's available and is a viable option for you. Another one, evaluate your corporate structure. That's one that we hear a lot, and we'll talk a little bit more about when we talk about the corporate structure, that you want to just make sure that you are set up in a way that is in line with your goals. You may have set up your corporate structure 10 years ago, and it was totally different, and some things that you're able to take advantage of today that may not have been the case before. So it didn't make sense to maybe you were set up as an LLC and it didn't make sense to elect to be taxed as an S corporation, but now that is the case, but you've never made those changes. So evaluate that and see if that would be a good option for you. Insurance or insurance planning. Some of the big pitfalls is not knowing your insurable need. There are a couple things that could result in you being underinsured, which people kind of probably talk to you a lot, but it also could result in you being overinsured. So that would be applicable for life insurance, disability insurance, all those types of overhead expense, long-term care. You want to know what your true insurable need is before you take that step to purchasing it. Not knowing how to best structure a policy. That's something that is very important. So what type of policy do you need for whatever we're trying to insure? So if there's a death benefit need, what's the most efficient way to do that? If the goal is to use insurance to accumulate cash and access cash in the future, what's the best way to structure that policy where it's to your benefit, not to anyone else's, right? We want your benefit to be the primary one that you're concerned with from a planning standpoint. Working with someone that's motivated only by commissions, obviously that can be an issue. That doesn't mean that you shouldn't work with someone that is going to receive a commission, but if they're motivated only by those commissions, are they putting your best interest in play? Remedies, work with someone who is completely independent. So that's something that we strongly believe in, independence, transparency. So someone that doesn't work for just one insurance company, and they may say to you, well, we have the ability to, I work for XYZ insurance company, but I have the ability to sell, other carriers as well too. Well, the reality of it is how loyal are they to that one? They do have minimums that they are going to need to be hitting with the carrier that they work for, so you can't be getting completely unbiased advice there. You want to work with someone that will educate you, again, be transparent, and ideally is fee-based, so someone that is at least charging a fee to cover some of their time and they're not completely dependent upon commissions. Benefit planning, one of the big pitfalls, and we talked a little bit about before, is thinking there's no options after your 401k. The 401k just being the best example because it's most popular and most people are utilizing it either as an employee or as an employer. But there can be plans out there that allow for additional deductions. There also could be non-qualified plans that could make sense if you're wanting to make contributions just for a certain group. That could be beneficial for your structure. A defined benefit plan would be an example here, and under the defined benefit plan, obviously a cash balance plan as well too, if you're familiar with those. Chasing the highest tax deduction, that can be a pitfall. Again, we hit on a little bit before, but obviously just trying to get the largest tax deduction and ignoring the expenses, and the expenses being the contribution that you have to make, the expenses that could be to administer any additional plan, that type of thing. So we really encourage clients to explore their options. Don't take no for an answer. Oftentimes clients come to us and they say, well, I asked my CPA or I asked my advisor what else I could do, and they said that there really wasn't anything out there. And that may be the case, but why is that the case? Be educated on that. Have an understanding of that. Really push that to have it explained to you. And oftentimes it can result in, oh, well, actually that I would be okay with that. There may just be a miscommunication there. Evaluate the cost and make sure that it makes financial sense for you, though, as well, too. So that's something that's really important that we encourage clients to take into consideration. Corporate structure. Some of the big pitfalls we see is my corporate structure doesn't really matter. When a client says that to us, generally they've gotten that message from their CPA, which really your corporate structure does matter. So to say that it doesn't matter at all, you want to make sure that you have the right one. So if you have, an LLC that isn't taxed in a way that could be potentially favorable to you, then maybe reevaluating that makes sense. There's just a lot of things to take into consideration when it comes to, things that would be potentially deductible. Again, when you set up your practice or your business 10 years ago, your situation has changed. It's something that needs to be addressed. Another one that we get quite a bit is I don't need to be incorporated. So you're set up as a sole proprietor. I think your attorney or David Mandel would disagree, from an asset protection standpoint. That's all going to fall to you personally. So you want to make sure that you're doing things that make sense from a legal standpoint, and then also that there's no benefit to making a change. And that really, some of those really all flow together. But you want to make sure, again, I would say challenge that. Why isn't there a benefit to making a change? Why shouldn't I be taxed this way? Why shouldn't I have this type of corporate structure? I've heard that this is a good thing. Be educated. Have someone explain it to you so you understand it. Again, evaluate your corporate structure from a tax, legal, and financial perspective. A lot of people do it just from a tax perspective. You want to make sure that it really fits in to your overall plan. So when we're talking about multidisciplinary planning, that's what we're talking about, is evaluating it from a tax, legal, and financial perspective. Financial planning. So some of the big pitfalls is not knowing what your goals are, not knowing what you need to be saving to meet your goals, whether that's retirement, college, or anything else. You really want to have those defined and have a good understanding of, okay, what do I need to do to meet those goals? Not knowing how much you can afford to be saving. So what we're talking about here is cash flow, and mainly personal cash flow here when you're talking about just personal financial planning. So look at your cash flow. When we take a client through our planning process, we look at their personal cash flow and we have them list out all of their expenses. Now, obviously, we help them and have a form that helps them make that a little less difficult. They don't have to just think of every expense that they have. But we're able to say, okay, here's what you're bringing in, here's what you're spending, here's what your taxes are, here's what your surplus is. Does that match up? Do you have the ability to save? Do you need to make changes to your cash flow if your retirement goal is your priority, whatever that may be? That's something that's really important. So you want to evaluate cash flow. Cash flow is going to help determine which retirement should probably really look like for you. But you want to always understand how much that you can be saving. Not knowing your insurable needs. So a part of obviously financial planning is review of insurances and what your need is. That is in line with a little bit of what we talked about before on the insurance planning. But you want to make sure that you have a good understanding of what your true insurable need is. You may be making $500,000 a year, but you're spending or you're living off of $150,000 a year, the equivalent of $150,000 on a pre-tax basis. So you don't necessarily need to replace your entire income. If you go by a rule of thumbs, you could be overinsured. Oftentimes when clients come to us, they're underinsured just because they don't have very little in place. But you want to evaluate. Let's really determine what is that exact number. What if something were to happen to you? what would you want to be taken care of? What you want the home paid for? What would the income that you'd want to be leave for your spouse, for the kids? Would you want education paid for? What's the best way to do that? So what's the true amount that you need? So define that amount. That is in line, obviously, with some of the remedies. So identify your goals, identify your need, and evaluate your cash flow. I mean, if you do some of those are just the principles, the foundation of financial planning. If you work with someone that's able to do that for you, then you're moving in the right direction from the financial planning perspective. Who should be on my team? So when you're taking a multidisciplinary approach to planning, you want to make sure that you have the right team members. Well, you're going to need an attorney, and you may need multiple ones. You may need someone that whoever does your estate planning may not be your business attorney. If you have someone that's if you have a need where you really need to hone in and specialize on asset protection. So really just identify who that is. We help our clients establish their team if they don't have one in place. Obviously, generally a CPA needs to play a role there. It's important to understand while we have attorneys and CPAs in-house, we don't draft legal documents and we don't prepare tax returns. An investment advisor, ideally someone that's independent and is with an RIA is what we would recommend, so a registered investment advisory firm. An insurance agent or someone that has the ability to do that. And then finally a quarterback. So what is the quarterback? The quarterback, that's the role that we try to play for our clients, along with being the investment advisor and the insurance agent. We have the capability to do that if clients choose to work with us in that capacity. So they may, obviously you can see there, we facilitate multiple roles for our clients, but not all of them. So you do need to have a team. But our goal of being the quarterback is to be overseeing the multidisciplinary process. So I play the role of quarterback for my clients. And David Mandel does the asset protection piece. Carol Foose, one of our partners, plays the tax role. We have an investment team. And my role is to really just play the quarterback and make sure that we're making optimal decisions in each discipline from a planning perspective. It's important, another thing to take into consideration, have you outgrown your advisors? That's something that is just really important and obviously is a personal for everyone, but you want to evaluate that. And do you need a quarterback? I think that's something that is really important to take into consideration. What now? So as we talked about, you want to identify your weak link. Is it your CPA? Is it your financial advisor? Is it you? Are you trying to do a lot of these things and you're not able to maximize that? That's sometimes we see that issue with clients. If none of your current advisors are playing the role of quarterback, then they probably aren't going to be right for that, for playing the quarterback, simply because if they haven't taken on that leadership aspect of it or wanted to be more involved, they're probably not the right fit there. And the other thing that's really important is you're not the answer at quarterback. And obviously, some people try to play that role and some people try to do that role all for themselves personally. And that doesn't mean that you can't be involved. That doesn't mean that you're not the backup quarterback. That doesn't mean that that you don't have a role. Obviously, your role is integral in any multidisciplinary plan, but you want someone that is overseeing and giving you objective advice and educating you, making sure that the recommendations or anything that you're putting in place for each discipline is in line with your overall plan. So how OJM works with clients, this is a really good slide to kind of recap what we talked about today. Generally when a client engages us, we take them through a very defined planning process where we're reviewing everything on a corporate and personal level of asset protection, tax reduction, corporate structure, benefit planning, retirement planning, insurance, and obviously wealth management or investment planning. And we are fee-based, so we charge a fee to go through that process. I think most people would find it very valuable just to have a second opinion or to be reviewed. That's really what the role of our planning process is, and it gives you the opportunity to determine, does OJM really bring value to the table? Is this someone that could be a part of my team, that I would want to be a part of my team? Obviously, I'm confident that that would be the case, but I think it's a good structure that gives clients the ability to kind of ease into a relationship with us. So obviously, that's our unique fee-based consulting approach there. It would be our planning process, our multidisciplinary planning process, where we're reviewing the asset protection, tax, financial and investment planning. We've worked with over 1,000 clients in 48 states. Again, we have a multidisciplinary approach, and we take into consideration the personal and the corporate planning. So for those of you that own your own practice or own your own business, the corporate and the personal world, there's a lot of overlap, so we don't want to look at one over the other. So next steps, you can get a free copy of any of our books. For doctors only, obviously is directed towards physicians. Fortune building for business owners and entrepreneurs, or more just from the business owner standpoint. We also have other books that are specialized for certain specialties, so orthopedic surgeons, dermatologists. You can go online and see those as well too, or feel free to request a copy. You can also go to our, you see down there in the lower right hand corner, ojmbookstore.com, and use the promo code WEB0715, and you can download any of our books to Kindle or iPad or PDF. We would love for you to schedule a free consultation where we can discuss your situation, talk about our multidisciplinary planning process, and how we could be a resource for you. And then obviously, if you have questions, please feel free to contact me directly. You can use the 877-656-4362, or feel free to email me at michael@ojmgroup.com. I thank you for taking the time today. Hopefully you have found this beneficial and educational, and we look forward to speaking with you in the future. Have a good day.